Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. This is Nikki Fu, Commercial Director at My Steel Global. Last week, global LNG markets continued to focus on geopolitical developments in the Middle East. Concerns surrounding Iran and regional shipping routes supported international LNG prices and kept market participants watching for potential supply disruptions. But China's LNG market told a different story. From July 10th to 16th, instead of moving higher alongside overseas markets, China's domestic LNG prices edged lower, inventories continued to build, and buying interest remained relatively cautious. So why did China's market respond differently? Was it demand, supply, or something else entirely? And looking ahead to this week, what should the market be watching most closely? Joining us today is Gary Gao, Gas and LNG Markets Research Lead at MySteel Oilchem. Gary, welcome.
Thank you, Nikki. Glad to be back.
Let's start with the biggest question. Global LNG prices strengthened last week as geopolitical risks increased, yet domestic prices in China declined slightly instead. Why didn't China follow the same direction?
The simple answer is that China's domestic fundamentals remained the dominant driver. International LNG prices certainly moved higher, and the import costs increased as well. But in China, market participants were paying much closer attention to the domestic supply-demand dynamics than overseas developments. China's feedstock gas auction prices, which determine procurement costs for many domestic LNG plants, continued to decline, reducing production costs for domestic producers. At the same time, downstream demand remained relatively weak, so there wasn't enough support for China's LNG prices to move higher.
So higher import costs weren't enough to lift market sentiment?
Exactly. Buyers remained cautious throughout the week and generally purchased only according to immediate production needs rather than building inventory. One of the clearest messages from last week is that higher international prices don't necessarily translate into higher prices in China. When its domestic fundamentals remain weak, overseas developments tend to play a secondary role.
Fair enough. Let's talk about supply. If demand wasn't particularly strong, did supply continue increasing?
Yeah, and that's really what shaped the market balance at the time. China's domestic production increased slightly as several LNG plants completed maintenance and resumed operations. Although the increase wasn't dramatic, it added more supply to the market. At the same time, imported LNG arrivals rose to 1.41 million tons, up 543,700 tons from the previous week.
That seems interesting because international LNG had already become more expensive.
That's right. China received more than 20 LNG cargoes during the week, with arrivals increasing by more than 60% week on week. So despite growing geopolitical uncertainty, LNG supply in China's market continued to increase. At that point, it was clear that supply was growing faster than demand.
So China's LNG market wasn't reacting to tighter supply. It was reacting to a looser supply-demand balance at home.
Exactly. That's why China's LNG prices remained under downward pressure despite higher import costs.
Let's turn to demand. How much of last week's weakness was driven by the poor weather conditions, and how much reflects broader market conditions?
Weather certainly had an impact. Persistent rainfall affected trucking activity across several regions, reducing LNG consumption from the transportation sector and slowing sales at LNG stations. But weather wasn't the whole story. Industrial demand also remained relatively subdued because pipeline gas continued to offer better economics for many users.
So even though prices eased, LNG still wasn't competitive enough to stimulate additional industrial demand?
Correct. Lower prices helped somewhat, but not enough to significantly improve industrial demand. As a result, China's overall LNG demand declined slightly during the week, while domestic plant shipments also weakened.
And I suppose that's exactly why inventories continued to increase. Would you say inventories became the clearest indicator of market conditions last week?
For sure, both China's domestic LNG plant inventories and receiving terminal inventories increased during the week, as higher production, strong imports, and weaker demand led to inventory accumulation. For this week, China's domestic LNG plant inventories are expected to edge up slightly to around 620,000 tons, while receiving terminal inventories are expected to decline to around 5.7 million tons as some stocks are drawn down.
Another trend that stood out was import economics. International LNG prices increased sharply, but receiving terminal prices across China were largely unchanged, with only a few terminals posting price declines. What does that tell us?
We could say that China's domestic buyers weren't prepared to absorb those higher costs. Spot import margins deteriorated significantly because international LNG prices increased while the selling prices in China remained relatively weak. Although global LNG prices were moving higher, China's domestic market simply lacked the demand needed to support those higher import costs. In short, demand, not supply, is still setting the tone for the market.
Looking ahead to this week, do you expect that balance to improve?
I think we'll see some improvement on the demand side. Weather conditions are expected to become more supportive, which should support transportation activity and gradually lift LNG consumption.
But supply isn't standing still either.
You're right. More domestic LNG plants are expected to return from maintenance, so supply will likely continue increasing as well. At the same time, international markets will continue watching developments in the Middle East. If geopolitical tensions persist, the international LNG prices and import costs could remain elevated.
So, what's the key takeaway the market should focus on this week?
China's LNG prices are likely to continue edging lower within a narrow range this week. The domestic supply will remain relatively ample as more LNG plants resume operations after maintenance, while demand should gradually recover, especially from the transportation sector as weather conditions improve. Meanwhile, falling production costs in most regions will provide less support to the domestic LNG prices. We expect average ex-plant LNG prices to fall to around 5,400 yuan per ton, with average market prices also declining to around 5,900 yuan per ton this week.
Gary, thanks as always for sharing your insights, and thanks to everyone for listening. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LNG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.